Russia's ruble has hit a 7-year high. The currency is supported by capital controls and month-end taxes, and they've offset the negative impact of what the West says is Moscow's first default in more than a century. The ruble firmed at around 53 against the dollar after hitting its strongest level since June 2015 at about 52.57. It's hovering around 56 against the euro. Now, the ruble had traded near 80 to the dollar and 90 to the euro before Moscow sent troops into Ukraine in February. Moody's ratings agency today confirmed that Russia defaulted on its foreign debt, with the country failing to pay bondholders around $100 million in interest payments. However, analysts say the declared default will have no substantial impact as it has already been priced in and the external debt market has been shut for Russia since the invasion began. Russia's ruble is, in fact, the world's best performing currency this year, despite the sanctions. But as Stuart Smith reports from Moscow, not everyone is celebrating.
For 15 years, Chapet has been designing and making clothes for children. They import their materials from India, China and Turkey and sell finished clothing to families in the Middle East and Asia. For this company, a strong ruble is only a good thing.
We import all elements and fabrics from abroad. So it's main fabrics, decorative fabrics, buttons, zippers. So we take it from outside. That's why for us, for sure, the strengthening of the ruble is very good, it's positive.
Although the ruble's strong now, it's been on a roller coaster ride since Russia launched what the government calls its special military operation. At the end of February and throughout March, the ruble plummeted to its weakest level ever against all major currencies. Government intervention and interest rate hikes hauled it back to familiar territory in the spring, and summer has brought the strongest exchange rates since June 2015.
For all businesses, the situation when you can forecast something and plan something is the best situation. Yeah, when it's go up and down, it's very difficult to plan something, to make purchases abroad, yeah, to make budget for the next year.
The ruble has remained in relatively strong territory for the past month. However, there's no guarantee the ruble will look this way next season. Economists say its strength now is partly a product of leftover government interventions from when the ruble was weak, but is mainly due to the gaping ratio between imports and exports, which are being hit differently by sanctions.
Current sanctions, which are already on, only influence 5% of Russian total exports. At the same time, imports plunged by 35% in April.
Reduced spending on imports means less demand for foreign currencies, and because exports have remained comparatively buoyant in spite of the sanctions, more export revenue is driving up demand for the ruble. But by the end of the year, the EU's oil sanctions are due to take hold, potentially shaking up that export-to-import ratio once again, with predictions that will significantly weaken the ruble. That'll be welcomed by most exporters outside the energy industry. The strong ruble has been making their products uncompetitive on the global market. The government would also prefer a weaker ruble for its coffers because its economic planning assumes a higher rate. The stronger ruble cuts into its revenue from energy sales, which are transacted largely in foreign currency, which then exchanges for far fewer rubles because of the currency's relative strength. With major oil sanctions on the horizon which could weaken the ruble anyway, the central bank is reluctant to intervene further. For now, it's a case of wait and see, although analysts believe the ruble has already peaked in terms of strength. Most Russians will only notice the strong ruble's effects in slightly cheaper imports, which in turn pushes down inflation. But whether weak or strong, Russia's foreign exchange rate is no longer a useful guide to how healthy its economy is. A patchwork of interventions are keeping it together. Year-on-year inflation remains in double digits, and the chief executive of Russia's largest bank says it'll take a decade to return GDP to 2021 levels without major structural changes. The central bank expects the worst effects are still to come. Stuart Smith, CNA, Moscow.